Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. And we are counting down to April the 2nd when Donald Trump is set to announce reciprocal tariffs. So markets on the edge as we count down towards that date. And we have seen quite a few volatile movements in the past few days. To help us navigate what is to come, we've got Vasu Menon. He is the Managing Director for Investment Strategy for Wealth Management Singapore at OCBC Bank. Vasu, good morning. How are you doing?
Good morning, Ryan. I'm very well, thank you.
Hey, lots to talk about. And of course, April the 2nd is the big day. And already we've been going back and forth with what might happen. He's been saying we might get some flexibility. It might not be that targeted. What are you seeing from the markets right now? What are they pricing in? What is going to be the pain that might come forth?
Well, Ryan, the markets have been in some ways yo-yoing. Yesterday night's rally on Wall Street took place against a backdrop of news reports that Trump might pursue a more targeted approach on April 2nd as far as reciprocal tariffs are concerned. And, these reports have even cited that he may only target 15 countries and he may not be as aggressive in sectoral targets as well. Now, Trump has talked about, imposing tariffs on the auto sector in the coming days. But as far as the pharmaceutical sector and the chip sector, he said that it's down the road. He didn't commit to an April 2nd, imposition of tariffs. So you're seeing, some flicker of light out there that seems to indicate that Trump may not go full on with his reciprocal tariffs on April 2nd. But then again, despite the strong rally on Wall Street yesterday, we all know that, Trump will flip-flop with his policies. He's unpredictable and, the course ahead is uncertain. So investors want to be careful. But at the same time, I think it also shows you that he may be using his tariffs as a negotiating tactic. And he may not go full on. He may carve out his tariff approach. And, that offers a little bit of hope, a ray of light for investors who are looking out over the medium term.
Yeah, so you might get more tariffs on the table. What's the impact of these tariffs when you look at the global growth picture and the inflation picture?
Well, clearly it's going to cause global growth slow down. So OECD is forecasting that, global growth will slow down quite a bit from 3.5% in their previous forecast to now, I think, 3.1%, and next year they're looking at also growth only picking up to 3.2 or 3.3%. So clearly there's going to be a hit in terms of global growth, not just global growth, also in the US. Mm-hmm. And inflation is probably also going to pick up as well. I mean, the Fed, for example, in its most recent policy meeting last week, upgraded its forecast for inflation from 2.5% to 2.8%. You see a similar picture, Ryan, back in 2018 when Trump pursued his tariffs. U.S. economic growth slowed down from 3% to 2.5%, and inflation in the U.S. picked up from 1.6% to 1.9%. But the key message is this. Are these tariffs going to be catastrophic? Are they going to cause economies to fall off the cliff, and are they going to cause inflation to shoot through the roof? And our view at this juncture is that, yes, they're going to cause the economic slowdown, they're going to cause inflation to pick up, but they will not be catastrophic.
Yeah.
And as a consequence, I think there's still reasons for investors who are, again, looking out over the medium term to remain hopeful.
Yeah, so we've seen prices go up for some assets, including commodities. For example, copper are now near record highs. And then we have the US core PCE price index coming online in a couple of days, which will give a bit of a signpost for the Fed to decide on their rate path policy. So with that in the backdrop, how should investors navigate what's to come?
I think investors want to be careful in the short term. We're not negative in the medium term. We're still risk on in the medium term. We're still positive in the equity markets. We are a bit more guarded on bond markets, but we are risk on. I think, short term is very hard to say how tariffs are going to play out. And I think investors want to be careful. I think the best approach at this juncture is not to panic, to stay invested. And if you're looking to put more money into the markets, not to jump headlong into the markets. I think you want to make sure that you spread your investments out over the next 6 months, 9 months, dollar cost average. I think dollar cost averaging is most appropriate in a market environment like this where markets are extremely volatile. And you've got a lot of noise in the background. So when you listen to what I say, I'm not negative. I'm suggesting actually that, this weakness in the market could present, moments of opportunities where investors can accumulate very gradually. So because I think that once, this whole episode of tariffs start to ease off as we go into the second half of the year, the markets could start focusing on the second T. Right now, everybody's focusing on the first T, which is tariffs. And the second T would be tax cuts from Trump. He clearly has to, do something to extend the current tax cuts which will expire at the end of this year. It's not a process that takes place, in weeks. It'll take months to negotiate with Congress. And that process could start in the second half, and that could provide some degree of hope, optimism for investors.
Yeah, Vasu, talking about getting into the markets, the opportunities to do so right now, let's turn our attention to China, where you have more analysts jumping on board saying that the Chinese property market is edging towards an inflection point, the latest from UBS. And this has them pointing at recent indicators, including existing home sales in 5 major Chinese cities, climbing by more than 30% from a year ago on a weekly basis. So when you look at China, what's your sense of where things are right now?
Well, things are looking better in China. In fact, the Chinese stock market is one of the best performing stock markets in the world year to date, right? So if you look at the Hang Seng China Enterprise Index, is up more than 20%. In fact, if I'm not mistaken, it's up 25%, which is the third best performing market in the world. If you talk about major markets, it is best performing major market in the world. So the Chinese stock market has done exceptionally well. It's even outperformed gold, which has done well this year. And we remain positive on the Chinese equity markets. We turned positive on Chinese equity markets in the second half of last year because we felt that, things were very badly beaten down. We remain positive. We think that, the Chinese government is quite serious about, stimulating the economy, trying to provide a backstop for the property sector. But on the property sector, we think that the picture is mixed. While you just highlighted that, sales is up 30% in some of the major cities, I think 5 of the major cities in China, I think the broad picture is still relatively mixed because home prices are still declining. In February, Chinese home prices declined by 5%. And I think we look at housing starts, you look at real estate investments, they're still declining. But the silver lining with the property sector is that, if you look at month-on-month figures in China, in between April and October of last year, home prices in China declined by 0.7%, which is quite significant on a monthly basis. But since November, that decline has come down from 0.7% to 0.1%. So it offers a flicker of light at the end of the tunnel. And I think, going forward, it's possible that the market may stabilize gradually. I think what's unclear is the unsold inventory of homes in China. But clearly, there's great resolve on the part of the Chinese government trying to put a backstop. And they've announced several measures, and they could announce more. The Chinese equity market is not expensive. It's trading at, about 10 times PE ratio compared to 18 times for the US stock market. So I think on a relative basis, there's still a case for China, but it's a very volatile market. Having run up so much already, investors have to brace for some kind of a pullback at some stage. Now, as long as you can accept the volatility, I think it makes sense. And just make sure that Chinese equities are part of a diversified portfolio and not something that you overinvest in. I think we have learned from history that, overinvesting in anything that's thematic, and China is clearly quite thematic right now, is quite dangerous.
Yeah, the trade war could also force China's hand to push forth with more stimulus. So lots to watch out for as we count down towards April 2nd. We've been in conversation with Vasu Menon. He is the Managing Director for Investment Strategy at OCBC Bank. Vasu, thanks as always for your time and great chatting with you.
Thank you, Ryan, for having me on the show as well.
Yeah, I'll catch up with you again soon, Vasu. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.